Today, I'm going to show you how simple and easy it is to start investing in 2025. And I'm going to show you without all the fancy terminology and just get straight to the stuff that you really need to know. I've got over £147,000 invested in the stock market, and it might surprise you that I only spend 15 minutes a month managing my investments. I'm going to break this down for you into 3 simple parts. I'm going to run you through what accounts you need to use and how easy and simple it is to set one up. Then I'm going to run through some of the best investments for beginners, and finally what you can expect as an investor when you do finally get started. The simple fact is, if you're not investing, your money is being eaten alive by inflation. And trust me as well, state pension at £230 a week just isn't going to cut it. You ask a pensioner what it's like living on state pension and they will tell you it sucks. So we do need to be thinking about investing. But I'm not going to be telling you to live like a monk either. You can still live your life now and make your money work for you so it pays off in the future. And we're also going to be doing it while we walk around the stunning Hazley Heath, which is known for its biodiversity, and it's where Churchill also ordered the tanks to train in World War II as well. And we're even going to check out some of the things that they left behind. So let's get into it. So the simple fact is that everything changed when technology had its big boom. Gone are the days where you used to have to pick up the phone and phone up a stockbroker for them to then charge you a fee to place that investment. You wouldn't really understand what you were buying. It might be on a recommendation. And these days you can literally open an app on your phone and be investing in under 5 minutes. And this actually just does blow my mind. And then in 1999, a big thing happened, and that was fractional shares. And essentially what it meant is that you could buy a portion of a share and still benefit or indeed lose out from that share price. So for example, if Apple share was £100, you could buy £1 of Apple share, and if the stock price went up, then your £1 investment would go up, and if it went down, then your £1 investment would go down. Now, why do you actually care about that? And essentially what it's done is it's opened up investing to so many people all across the world. And essentially now people that couldn't afford it now can. And this has been a game changer for investing as a whole. And even if fractional shares have been around since 1999, it's only really since 2019 when the rise of these fintech brokers and investment apps actually started to really kick off. So even then, we've actually only really had access to this as retail investors, which are people just like you and I, which can get access to the stock market for around about 6 years. So we can't really have expected it to have taken off that much. That's why I'm making this video, for example. And the other thing that stops people investing is, of course, risk. Most people don't understand risk, and they just see the warning signs everywhere, and it puts them off. And the thing is, risk is obviously there when you invest. There's no getting around that. But when you invest for the long term, there was a study done by Schroders that showed when you invest for 20 years or more, you have a 0.1% chance of losing money. Now, if I said to you, you got a 99.99% chance of making money in 20 years, you'd be biting my hand off. You'd literally take it every single day of the week. So why is it when it comes to investing, it really stops us? And really for me, it all comes down to knowledge. And so in this video, hopefully I'm going to put aside some of those fears and give you the knowledge that you need to actually start investing. But before we go anywhere, we need to know what type of account we need to use when it comes to investing. So let's get into accounts. So first off, when it comes to accounts, most people are surprised by this, but if you have a workplace pension, then you're already an investor. So your workplace pension is invested into the stock market. Now, one of the biggest hacks for people to get started, something which you could do right now today, and I'll tell you a little story about why it actually matters, because people hear the word pension and they're like, oh, boring. And I get it, because look, pensions, you can't access the money until you're 57, and that's not ideal. So basically the reason why I say this is because my mum had £65,000, which she found in a lost workplace pension when she went searching for her old pensions. And the reason why I tell you this is because she was on a default plan. Now, the default plan is essentially what they give you when you join a company, and it's your responsibility to go out and change that. But the default plan is usually invested in more what's called defensive plays, for example. So if my mum had moved to even a slightly more adventurous plan, even a balanced plan, we worked out she'd have had over £110,000. Now that's something you can go and look into today, speak to your HR and look into that right away. Right, now let's get get into the good stuff. Now, in the UK, we have something called an ISA. Most importantly for you guys is a stocks and shares ISA. And you can put up to £20,000 each tax year into a stocks and shares ISA, which makes it a pretty fantastic account. And the reason why it's so good is that everything you put inside it is all yours. All of your gains, everything you earn is completely tax-free when you take it out. But most people get confused about what an ISA actually is. And it's not actually the investment itself, it's the account that you use to invest with. Now, what I mean by that is, let's say, for example, you had a shopping basket, right? And you took it to the supermarket. Now, all the investments are the things that you put inside the basket, but the ISA is the basket, and that is where your investments live. So it's the account that you use to purchase your investments. Now, you've got three main types of ISA, and they are essentially a DIY ISA, which is where you do it yourself, and they usually have a little bit of lower fees, but obviously you're doing everything yourself. And you have an expert managed ISA, which is where someone will manage things for you. And then you have something called a robo-advisor, which is where you answer a bunch of questions, and then they will build a portfolio for you. But again, the expert manager and the robo-advisor tend to cost a little bit more, but you're paying for the convenience of somebody else doing it for you. So really, that's all you need. It's a stocks and shares ISA, and you can literally open one up in about 5 minutes. All you need is your ID, your proof of address, and that is pretty much it. You can get going straight away. Sometimes they ask you for your national insurance number as well. And that is all you guys will ever need to start investing. And get one set up right away. Now, there's a few things you want to watch out for when you're choosing an ISA. The first one is fees. And essentially you want to keep your fees as low as you possibly can. Now, there are some brilliant low-cost providers out there. A simple Google will bring them up for you, and we'll leave a link to some in the show notes below. But essentially you want to keep your fees as low as possible. Even a 0.5% increase in fees ends up being tens of thousands of pounds over the course of your investment lifetime. Then number two is you want ease of use. Does it have an app? Can you use it super easy? And is it nice to navigate around? And then number three is the types of investments available on it. Does it have a wide range of investments that you can easily access, buy and sell on the stock market? So now, guys, you know all about ISAs. And next off, we're going to move on to some of the best investments that you can buy as a beginner to keep things super simple and easy. So guys, where do you actually invest? Well, you've got a few choices. You can either buy what's called funds, or you can buy individual stocks or companies. Now, I've got a really good way of understanding the differences between the two, and that is using chocolate. Hello, babies. Now, I don't have any chocolate on me today. I probably would have eaten it by now if I did, but essentially what we're going to do is we're going to understand the differences between funds and stocks using chocolate. So in this case, we've got Apple. So everybody owns an iPhone. You all understand that Apple is on the stock market. And in this case, Apple is a Mars bar. When we go to the shop, we buy our Mars bar, let's say for £1 in this example, and then we own that Mars bar. Now, when we own just one Mars bar on the stock market, if the price goes up or the price goes down, we only own that single chocolate bar, so that single company, and that right there is an individual stock. But essentially owning an individual stock or company, if we only own that, is quite risky. So there's something called a fund, which is less risky and also gives you a lot more individual companies all in one basket. Now, let's take chocolate again as another example, but this time we'll use a box of Celebrations. So our Mars bar is now inside that box of Celebrations, but we've got Twix, we've got Bounty, ooh, Bounty, we've got Snickers, we've got lots of other companies that are now inside that box of Celebrations. And that is what a fund is. So you're not gonna go out and buy every single individual chocolate or company that is inside that fund. You buy a box of Celebrations for a set price. And that's exactly what you do when you buy a fund. But when you buy that fund, you own lots of different companies inside of that chocolate box, which means if Mars bar does badly, sometimes Twix, Snickers and Bounty are doing better, and so things balance out, which means it's a lot less risky. Now, there are many different types of funds, but one of the best ones that which we're going to discuss today is called index funds. Now, index funds are essentially just lists of companies. That's all they are, and they're packaged up inside of a fund. Now let's take a popular one, for example, the S&P 500, which is the 500 largest companies in the USA. Now, what that means is that when you buy that fund, you buy a portion of all of the 500 companies inside it. And the reason why indexes are so popular and why they're so great is, one, they're very efficient. So if the company that's in 499 starts doing badly, it's simply replaced by one that's doing better than it. So that company could be sitting in 502nd, it has a great year, and then it replaces that company that's doing worse than it. And the second reason is they're very cheap as well. And the third reason is they're very difficult to beat in terms of performance as well. So that's why they're so popular for beginners, intermediate, and more experienced investors alike. But for me, the best investment of the lot has to be a global index fund. And it's essentially you investing into the world's economy with one single investment. You still got your Apples, your Teslas, and your Microsofts within it, but you have thousands of other companies from all over the world in one single investment. Now, honestly, that is the best place for a beginner to start investing. Many experienced investors go through that their entire lives. They just invest into a global index fund. So really, you don't actually need much more than that. But of course, you can obviously add a lot more to that. And there is a lot more to learn about investing as well. But definitely for the first year, I would literally just do that. Now, next up, I want to talk about what to expect when you do become an investor, because it's not all sunshine and rainbows as much as we would love it to be. It's really not, especially in the short term. Now, in the short term, the stock market is a voting machine. And in the long term, it's a weighing machine. Now, what do I mean by that? Well, essentially, in the short term, markets are irrational, meaning that the slightest bit of bad news, you've probably seen it recently with President Trump throwing his toys out the pram and tariffs on every country he can possibly muster, that has caused the markets to go down because it's uncertainty, right? So news can really shake things and it becomes a bit of a voting machine. But in the long term, it's a weighing machine. Now, when these companies grow and their earnings grow with it, it means that their stock price should increase and eventually will increase with their earnings growth. So how do we as investors get around this? Well, there are a couple of ways you can do it. Now, what I would start doing is thinking in decades rather than years, months, and days. Essentially, delay your gratification. Any money that you invest now, you should be putting it in for a minimum of 5 years, but ideally 10 years or more. And then to make your life easier, I would automate absolutely everything and set up monthly investments. So direct debit straight into your investments. Now, this is called pound cost averaging. And what it does is it essentially means that you buy every single month, maybe the day after payday, maybe on payday, come rain or shine. And what that does is just take the emotion out of it. It becomes like a habit which happens without you even realizing it's happening. And the reason why pound cost averaging is so powerful is it means that you're buying sometimes when the markets are up and sometimes when the markets are down. So over time, your average purchase price for that fund or that investment, whatever you decide, is essentially going to average out over a long period of time. Now, it's very, very difficult to time the market. So selling when it's high and buying when it's low. Even the best investors in the world fail at this. So why bother trying? And it's something like 90% of active investors. So people that are trying to time the market, these are people trying to actively buy and sell, end up underperforming an index fund. So it just goes to show, why bother trying? And guys, look, we've covered a lot of ground today. I'm absolutely knackered after all this walking, but I have created you guys a free investing guide and it's available in the show notes below. You can literally hop down there, grab it free, pop your email in, and we will send it right over to you. It's a 10-step checklist, literally running through most of what we covered today, but just laid out in a way which is really nice and easy for you guys to understand. But honestly, the best video to follow on from this is coming up on your screen right now, and I'll see you guys over there. And it's been a real pleasure. Catch you on the next one.